Check the big board. We're down 37 points. Not that much movement. A majority of the Dow 30 are in the red. That means they're down. But look, we've got 8 straight weeks of gains as we start this new year. It's looking good. I think our next guest agrees with me. It's looking good for the future. Ryan Payne with Payne Capital Management is with us again. One quick point here. You say that the market hasn't yet priced in fully a trade deal with China or the Federal Reserve not going strong on interest rate hikes. I thought we had priced it in.
No, we got to remember, and we talked about this last time, you're coming off such extreme lows in December. We're just getting that to normal valuations right now. So if you think about it, like last year, we had earnings of like 24% across the board, and the stock market was down 6%. So there's a huge dislocation with how companies have done and basically where stocks are priced right now, even with this comeback in the market.
So you think we've still got a ways to go on the upside till we catch up, right?
That's right. That's right. Exactly right. So we're still behind that. And also think about there's so much cash that left the market last year. You had like $260 billion leave equity funds. So most people missed the boat on this rally. They're sitting on the sidelines. They're wondering, do I get in? Do I wait? So if you get good news like China, let's say we do strike a deal, you're going to see a capitulation to the upside where people are going to be like, I have to get out of cash now. I've got to get back into the market. I think that's your biggest risk here, Stuart.
Okay. There's a couple of items here on the consumer. At the first of all, retail. Walmart stock, that is way up today after they reported stronger profits and very good sales during the holiday quarter.
Yes.
So that's a plus for consumers. And then we've got the New York Fed. They're just out with a new report that says consumers will spend more this year than they did last year. That puts the consumer in the driving seat for this economy.
And that's very good because the economy is about 70% driven by the consumer. So if the consumer is doing well, invariably the economy should do well also.
What happened? All these doom and gloom stories. Oh, the consumer can't afford this, can't afford that. We're only $400. Nobody's got enough money to meet an emergency. You don't have $400 in the bank. All these tales of woe we keep hearing. And then you get this from Walmart.
It's crazy. I mean, you would think it's like the 70s in England, but it's not, right? I mean,
it's not that bad.
It's not that bad.
It's not even close. Why did you bring that up?
Because you brought that up about 2 episodes ago, so I was thinking about it in my mind.
I did. You're quite right.
Yes.
And that's when I left England in the mire of socialism.
Music was great, but the economy wasn't.
Yeah, that's very true. But it's the opposite in America now. It seems like this really is a booming economy, and the consumer's leading the way here.
And nobody believes it. I think the thing that we forget, though, is the consumer is a lot more conservative now than they were pre-2007 recession, right? At that point, people were much more leveraged up. They're spending a lot more. People are making more money right now. Wages went 3% last year, but they're just a lot more cautious than they were, which is a good sign. That's healthy.
Okay. Are you a millennial?
I'm just outside of it. Age 40. I just missed it, Stuart.
Sorry about that, son.
That's right.
Millennials, they are now the largest age group in the country.
Yes.
There's 83 million millennials, and they're all of voting age. So what are they investing in?
Well, we're finding right now, because we have a lot of millennials coming into our office, because we have a lot of millennial financial advisors, is they have a lot of money sitting in cash. They're actually very, very conservative because they were at home when the recession hit. So ironically, baby boomers are much more aggressive than the millennial generation just because they're way more cautious with their money. So they're ready to invest right now, but they've been in cash for a very long time.
And when they come into your shop, do you tell these millennials, hey, get out there and buy some stock? Do you say that?
Of course. I'm
well, you could tell them to go buy some bonds. I mean, you could play safe, but that doesn't seem like the right approach for a millennial who's got 30, 40 years to go to retirement.
Right. You have to tell baby boomers now they have to own bonds. You need to tell millennials that, yes, you need to start to take some risk because you have a long time horizon.
Yeah, and that's what you're telling them?
Absolutely.
And this market goes up from here?
I'm absolutely bullish.
And you get to a brand new high for the Dow Industrials?
We'll be talking about this year on this show.
Okay, all right. I look forward to it.
Wow.
Mr. Payne, thank you very much for joining us, sir. We appreciate it.
Thanks, Stuart.